Bloomberg Audio Studios. Podcasts, radio, news.
I'm very pleased to say that joining us on this programme, Howard Mark joins us for more. Howard, welcome to the programme, sir. We want to start with a central question that you pose yourself. Why are asset prices so strong in the face of what you view as net negative developments? Howard, can you share your thoughts with us?
I'm glad to be with you this morning. Of course, as the quote you just put on the screen indicates, this is all just feeling and an opinion. None of this is factual, but it does seem that stocks are expensive relative to what I call fundamentals, or you might call reality. And the outstanding reason, I think, is that there hasn't been a serious market correction in 16 years. So people get out of the habit of thinking about market corrections. The biggest single mistake, I've been thinking a lot, what is the biggest single mistake investors make? And I've concluded that it is that they conclude that the way things are today is the way it'll always be, and the things that have been happening will always continue to happen, whereas reversion to the mean is much more likely. So I just think that it's worked very well. Being an equity investor has worked very well. Doing it on leverage has worked even better. Concentrating in a few stocks has gone very well. Investors are by nature optimistic, and that optimism dies hard. I just think that the fluctuations of the market are mostly related to psychological fluctuations, and people go from neutrality to liking stocks, to liking them a lot, to liking them a ton, to liking them too much. And that's the continuation that creates bubbles. And, we probably in the early days of that.
When you talk about liking, Howard, maybe liking these assets a little bit too much, can you put into perspective the last time you saw this type of environment that left you thinking maybe some of the opportunities aren't as great when it comes to buying some of these assets at current valuations? Is there another time that this sort of reminds you of in any capacity?
Well, I guess, Lisa, the last time was probably around 97, when the market was kind of falling in love with tech stocks, and the market was rocketing along. People were not worried about the level of valuations. People were extremely optimistic about the opportunities for the internet, Alan Greenspan famously cautioned that there might be irrational exuberance. Now I picked 97 because even though Greenspan was concerned about exuberance, the market went on to rise for another 2.5 to 3 years. So remember, I said we're in the early days. We're not at a critical, at a nutty valuation. I'm certainly not ringing the alarm bells, as the quote that you had on the screen said. No reason to think there'll be a correction soon. But the point is that things are expensive, they may go on to become more expensive. But the fact that they're expensive, it should not be lost.
And Howard, I think a lot of people point to, in terms of the echoes of the late 90s, the tech sector of the market as being the most overvalued. What I thought was so interesting about your memo is that wasn't your take, that wasn't your bigger concern in the market at a time when people are counting on a certain robustness of growth and a certain kind of inflationary backdrop. Why is it that tech isn't the focus of your concern this time around?
Tech contributes to the aura that surrounds the markets. And a lot of people have been citing the fact that the so-called Magnificent Seven, stocks like Amazon and Alphabet, have been contributing disproportionately to the rise. And they're responsible for more than 7 stocks. Their dollar gains have been responsible for more than half of all the gains in the 500 stocks in the S&P, 7 out of 500. But they're great companies. They're at high valuations. I think that I can't say those valuations are excessive. But the other 493 stocks are quite highly valued, not as highly as the Magnificent Seven, but nobody says they're the same quality company, quite highly valued relative to history. And it is the fact that high valuations are being applied to more average companies that I think's more alarming than the fact that exceptional valuations are being applied to exceptional companies.
Howard, there's a quote you use in this memo. I enjoyed this quote. You said, "He who knows only his own side of the case, knows little of that." And then I worked through the rest of the memo, and there was a conclusion there about credit. And I just wonder, sir, whether your focus on equities in this note offers you a greater perspective on how much value is offered in credit right now.
Well, it's as John Stuart Mill said, and I believe it was 1859. You have to know all the sides of the story to understand whether your side holds water. And I cite the bull case there for why the market isn't overvalued. I think that's part of the job. But as you say, my conclusion is that I'm not, as I said before, I'm not raising an alarm bell, but I do think it's time for some caution. And this is a little bit of what we call on Wall Street talking your own book. But what I do, what Oaktree does, is mostly something called credit, buying the debts of companies, and debt is inherently more defensive than equities. And you have a promise of payment. You know what your return will be if they pay interest and principal as promised, and most of the time they do. So I just think that this is a time to put a little more defense into your portfolio, and investing in credit as opposed to equities is one way to do it.
Is it still defensive, Howard, if you're looking at credit spreads that are the tightest since 1998? I'm looking at investment-grade credit spreads, which are thought to be a more defensive part of the credit market. I mean, does that sort of question what it means for it to be defensive when the valuations are high there as well?
Well, first of all, Lisa, debt or fixed income or bonds or what I call credit, all different words for the same thing, is different in nature from equities because you do have a promised contractual rate of return. And you can say that the promised contractual return isn't as high as it has been historically, or the increment that it provides over treasuries to compensate for the credit risk isn't as high as it has been historically. But you can't say that they don't promise 7.5%. And a promise of 7.5%, you're going to pay some fees. You're once in a while going to encounter a credit loss. I think it's highly likely to provide, let's say, a return in the 60s over the next 10 years. A contractual guarantee approaching something in the 6s over the next 10 years is, I think, more defensive than being in the stock market at these elevated valuations. That's the point. You just said tighter than they have been since '98. If you looked at where they were in '98, and you hypothesized an investment in a portfolio of high yield bonds in '98, how did you do over the last 27 years? And I think you did fine. That's my point. It has a high probability of doing fine, whereas stocks, if the valuations are elevated, have some reasonable probability of doing less than fine.
Is the United States still the focal point for defensive investments? I think I said in the memo that I think the U.S. is still the best place in the world to invest.
The things that make the U.S. exceptional, the spirit of innovation, the free markets, the rule of law, the capital markets, the growth and dynamism, the great companies, these things are still all true. But as I said in the memo, we're the best place. We may be a little less best than we used to be. The world is thinking that maybe the U.S. is a little less best than it used to be, and I can't argue against that. I mean, fundamentally, as an investment environment, I think things are a little bit deteriorated.
Is there a place where you see has more opportunities right now just based on valuations and based on maybe a firming up of contract law and other aspects that really lead to a robust investment backdrop?
Well, as I say, I still think we're the best place in the world to invest. You know, we're a great car at a high price. You can get some cars around the world that are not as great as ours, cheaper. Which do you prefer? Less good at a cheaper price, or better at a more expensive price? So, you know, other parts of the world do not have our dynamism. Lots of places in the world are overregulated compared to the United States. But if they're on sale relative to the U.S., it's not unreasonable to want to have some representation there.
Howard, wonderful to get your thoughts. As always, sir, you've been generous with your time. We appreciate it. Thank you very much. The legendary Howard Marks there of Oaktree Capital Management, following the release of his latest memo in the last week or so.